very sharply from the day's low. Well, it was the RBI commentary volatility, but then market are coming to terms with it. One area of the market which is doing phenomenally well is the consumer tech names. We'll talk about all of that as we go forward in the show, but let's welcome the guests on our show today. Abhay Agarwal is joining us from Piper Serica. Abhay, first of all, I'd like to understand, thanks very much for joining us. What are your thoughts on RBI commentary, especially on growth? And, there was a kind of a googly in the end saying that, we have elbow room to take further actions as appropriate depending on the data. For a moment, it did scare the market that more rate hikes are perhaps on the table, didn't it?
Yeah, Ajay, first of all, thank you for having me on the show. Always a pleasure. You're right. I think what we are seeing is that in an environment where inflation seems to be tapering off, the central banks, not only RBI but even the US Fed and ECB, are look like they are willing to take their foot off the pedal, for increasing the rates. But at the same time, they want to not give the market an indication, a clear indication that rate hikes are over. So I think while we have probably seen the worst of the rate hikes, and if this low inflation environment continues, I think rates will peak out pretty soon. At the same time, no central banker is willing to give a clear guidance. I think they want to keep telling the market that, look, if things deteriorate, if inflation goes up, we have the ability and we will not shy away from raising rates. So I think that talk is just a caution to the market that, look, don't take it for granted that the rate hikes are over. And I think that pressure will continue for another 2 or 3 months till we can conclusively say that, look, this inflation pressure is off us.
Okay. What do you make of the change in the commentary from some of the founders of these consumer tech companies? It was earlier Vijay Shekhar Sharma at Davos sounded off the profitability bigule, and then how the numbers actually panned out. And now Dipender also saying, and CLSA responding that Zomato could turn around this quarter. Big hectic buying happening there. Have you dipped in your feet in that zone or not yet?
Not yet, Ajay. We are tracking, obviously, because some of these are, humongous national brand names, and they have created a phenomenal franchise, and they are, especially some of the food delivery companies, Zomato, Swiggy, they are in a duopolistic structure. So they're very interesting to track. And it is very heartening to see that there is this realization at the founder level that, look, for whatever it's worth, now that we are listed, we need to focus on profitability. We cannot keep burning money and chasing growth, just for the sake of growth. So it is first of all quite heartening that that message from the markets has been well taken by the founders. They're saying the right thing. But I think the jury is still out there that how will it actually transform into numbers? Because the worry is that when we look at the unit level economics of some of these new age companies, and I'm not just including these two that you mentioned, but the others that listed last year, I think a lot of them are still struggling with unit level economics that are not profitable. So I think what we are going to do is to maybe watch for another quarter or so to see this desire for profitability actually translate into profitability before we pull the trigger. Because while the analysts are quite excited now, they can easily get unexcited if the numbers don't follow through.
Fair point. So could we get into a situation for the markets for the next 6 to 8 months where there is no conclusive evidence that rate hikes are over for sure? Meanwhile, growth could get impacted because global growth is actually coming down. So we could actually be in a period where the market could remain range bound, especially the key indices or even mid cap, small cap for that matter.
No, I think that is the base case that we are working with, Ajay, that for next 6 months, we will see the broad index Nifty itself in a tight range of, maybe about 5%. The reason for that is one, it is a fairly valued index. If you look at the 50 stocks that constitute the index, at the index level, the valuation is such that for foreign investors, it is tempting to look at other emerging markets that may be slower growth, but on a valuation metric, they stack up better than India. So some of the passive money may not come into India. In fact, we're seeing that already in terms of the FPI flows that been taking place, not big numbers, but small numbers that are keeping a lid on the market. So I don't think these FPI flows will reverse in a hurry, because I don't think that earnings in India will spike in a major way in this quarter and the next quarter. So that will keep a lid on the market. At the same time, I don't think there is a case to be made that the bottom will fall off the market because of some unknown things. So that is why I think it will be a range-bound market where astute stock picking is what will lead to market beating returns, and investors will have to get out of their comfort zone and make those bets. Look at sectors that have been beaten down unnecessarily, value is emerging, and bet on those rather than stay with the popular names.
Abhay, have you booked profits in your banking bets, the small and mid-cap banks which you had bought some time back? Because there is talk that perhaps the NIMs for many of these banks may come under pressure next couple of quarters. Or do you think that is still not baked in and it's worthwhile to remain invested in some of these names?
That's a very good point, Ajay. So first of all, no, we have not booked any profit. We see them as long-term plays, franchises that are getting stronger. At the same time, I think the best NIM is behind us for sure, for multiple reasons. Some of them are technical, some of them are fundamental. I think to get CASA growth now, banks will have to increase the cost of borrowing, which will impact the NIMs. The good news on the other side, Ajay, is that the credit quality is pretty strong and improving. So we are not seeing any pressure of credit quality, even on lenders that are, largely unsecured lenders. So that is a good news that there is better credit quality, which is supporting the NIMs because credit costs have come down, provisioning has come down, and at the same time, GNPA and NNPA for the sector as a whole have improved. So I think there is still tremendous value in a positive environment to look at banks and financial services companies that are trading at 1 to 1.5 times book value and are confident that they will grow the book by 20 to 25% over the next 3 years. I think once investors can identify these bets and stick with them, we will definitely see, multi-bagger returns.
Last word, we are also at the fag end of the earnings season. How have your portfolio companies fared this season? What was the kind of profit growth, margin pressure, if any, and the revenue growth which was clocked so far? If you could share a glimpse of the kind of numbers your portfolio throwing up.
Yeah, so I think Ajay, ours is a varied portfolio. We are sector agnostic, so we have companies that range from say a large cap Titan going to a small cap Gokaldas, which is an export company. So when you look at that broad range, of 20 odd companies, different industries, different capitalization, different target markets, it is very difficult to draw one or number of the entire portfolio growth because some of them are still going through their cyclical down cycles. But I would like to say, Ajay, to answer your question on a qualitative level, that we have seen that there is margin pressure. And the reason for that is many of these companies are unwilling to let go of market share or let go of volume. What they're doing is they are compromising on margins, absorbing the raw material prices increase in order to maintain or increase their market share and use their balance sheet strength wherever they can. I think that is a good long-term strategy to build market share, even if you have to let go of margins in the short term. And the commentary that we have heard from the recent conference calls that the companies have done is that definitely the inflation pressure on raw material prices is tapering off, and they are seeing lesser pressure, they are seeing volume growth. So that is quite a positive development. There is still caution, but I think overall we are on the right track.
All right, Abhay, thanks very much for your time. Great chatting with you, as always.
My pleasure. Thank you very much.
Let's take a short break.